Let me just mark the first rates, and the first rates will come up on any second now. There you go. 89 points higher for the Nifty. It's uptick of about the breadth is where the big talking point is. I mean, for me, the breadth, I think, is the whole and soul of what is happening in the market, because the breadth is so powerful that it really does not matter what the Nifty is actually doing. I just want to mark Varun Beverages. I just want to mark some other stocks in news, IT largely because of the Accenture numbers. Varun Beverages, yesterday it was Devyani, and Varun Beverages now. It's a bull market, guys. When the company is talking about expanding, going out, adding new geographies, markets like it. In a bear market, when company talks about expanding, going global, markets would say that, look, it's going to be capital allocation problem. So Varun Beverages is the top draw this Wednesday morning, followed by IT. Let's look at IT stocks. TCS, Infosys, Wipro. Nothing major from IT, major Accenture, but the impact on IT, I think some would say that the worst is behind. That is what you seems to be getting in terms of commentary from Accenture, and that I think is helping the mood for IT per se. You want to look at Zomato, 130 rupees. It made a new multi-month high, not far away from an all-time high now. It's a flat start. There is Paytm, nothing large in terms of a move there. And then let's look at IRCTC, because it went up on Monday, came down on Tuesday, and it is off to a flat start this Wednesday.
Yeah. While of course the star performer is Varun Beverages, there's also Manappuram Finance. They ventured now into EV financing, and the Asirvad IPO is expected by about mid-Feb. There's also Embassy REITs. Blackstone is sought to exit Embassy REIT via an $833 million sale, so look out for that as well. Anupam Rasayan, wherein Tech has now initiated a buy, target price of 13.10. Deepak Nitride, we just told you that they've signed an MOU with Petronet LNG for about 15 years. So these are a bunch of stocks which are going to be in focus, as would be the case with BPCL as well. They're looking at setting up a polypropylene unit project at Kochi refinery for about 5,044 crore rupees. BPCL is roughly holding out in the green as we speak right now. There's Dalmia Bharat as well. Their operations have resumed at Kolhapur as well as Neena Devi units. There's Astral as well, wherein the promoter is likely to sell about 2% stake via a block. And yes, Tech Mahindra too. Mohit Joshi has now assumed office as the MD and CEO as CP Gurnani retires. RVNL is the other one in focus. The joint venture, they've been the lowest bidder for railway station project in Kerala, worth about 124 crore rupees. So look out for this too. There's Religare Enterprises as well. The Delhi High Court has now set aside a declaration of the lender's exposure to RFL as fraud. So look out for this particular tire. JK Tire, which has launched a QIP, floor price at 358 thereabouts. So lots of these small stocks which are in focus as we speak right now. But let's take stock of the first trades. Kunal, a record start once again, well above 21,500. What stocks are looking attractive to trade?
Yeah, so I think good start for the indices. In terms of the opening trade, Voltas is something which looks attractive at current levels. So that's a stock which flagged off yesterday also, and above that 900 mark specifically. So would suggest a buy as well as look to buy the stock from a short-term kind of a time frame.
Right, Naresh, what are the first trades you're punching in?
So continue like Motilal Oswal, accumulating it with a short-term view.
All right, Mahesh, Nandurkar joins us, and it's that time of the year where we talk about and reflect back on the year gone by and talk about what trends we should expect for 2024. Frankly, in our book at ET Now, we feel that this is a year of beating the odds. Yes, at the beginning of the year, nobody anticipated such a stellar rally in benchmark indices. The fact that Fed would talk about interest rate cut, the fact that we will see back of inflation, and we will see such a stellar rally in just about every asset class, from gold to Bitcoin to small cap to mid cap stocks. So what has really surprised everybody? If I look at the year-end targets for 2023 at beginning of January, Goldman Sachs 20,000, Jefferies 18 to 19,000, BofAML 19,000, Kotak Securities 18,000. So everybody is pleasantly surprised with what we thought in January 2023 versus where we are in December 2023. Mahesh, that's the tone. That this year the odds in a sense have managed to defy law of gravity. What to your mind has been the surprise factor? Why are we in for such a grand year? And what has changed in terms of assumptions from January and now?
I think the big thing which has been a big positive surprise for this year CY23 is that the way the market has reacted to the rate hikes. At the beginning of the calendar year, it was already quite well known that the Fed would be raising rates, and they did. And we've actually seen one of the steepest rate hike cycle in the history of the US markets. But yet, I think the market did very well, because I think while the rates kept kind of moving up, the QE, which was initiated by Fed, does immediately after the COVID, implied that there was a lot of liquidity still sloshing around in the system. And while the rates kept going up, the liquidity still propped up the global markets and all the asset classes that you're talking about. So that's been a big positive surprise. And now we are come to the end, and therefore we are looking at the latest Fed commentary on the rate cuts. So my sense is that rate cuts is definitely going to be a sentimental positive, but just like the way we saw a positive surprise coming in from a very strong market reaction despite the rate hikes in CY23, the rate cuts of CY24 need not necessarily be interpreted in the positive way like we used to interpret earlier. But I think what still remains is the fact that there is ample liquidity in the global markets. And what is positive for India and generally for the emerging markets is that most likely this year will mark the peak of US dollar. The emerging market currencies such as India will be doing much better this year. And that is an ideal environment for foreign flows to come into emerging markets and in India. So while we've had a stellar CY23, I think CY24 should continue with that strength, and we should be expecting strong double-digit returns for the Indian markets in CY24, unless something goes wrong terribly globally.
CY24, which is we are talking about January 2024 to December 2024, you expect benchmark indices will give double-digit returns, but you're also accounting for the election volatility in that, I'm assuming.
Yeah, for sure. Election volatility will play around somewhere around like April, May. But I mean, obviously, we have seen some of the opinion polls, we have seen the consensus expectations, and it looks like the market is bracing up for political stability. Some of the recent state elections also were in the similar direction. So, so as I said, unless something, goes wrong terribly globally or politically, I think the markets would be in for a good stead.
When you say markets would be in a good state, are you cognizant of the valuations? Because we are now just a shade in and around our 5-year average.
Absolutely. Absolutely. I think the valuations, is something that has, kept a lot of foreign investors still at bay. While CY23 was a reasonably good year for foreign flows, but that was very, I would say, not a very broad-based flows that we've seen. In fact, my interactions with most foreign investors still suggest that several of the emerging market investors are only marginally overweight on India, much lower than what they used to historically. And the primary reason has been valuation and the political uncertainties that you alluded to. So my sense is that CY24 will see strong foreign inflows. And many of the global mandates, I'm not talking about the emerging market mandates, because emerging market investors, have India as a part of their benchmark, about 16-17%. So they are following Indian developments pretty closely. But I'm quite optimistic about the global mandates, where India's neutral weighting is very low, just about 1 to 2 percentage points. And those kind of funds haven't really taken big positions on India as yet, barring a few. And I'm expecting more flows coming in from that side. And as I mentioned earlier, the weakening of the US dollar and a strong performance of the emerging market currencies and Indian currencies expected for CY24 will be a big draw in my view.
What are your earning estimates for next year?
So FY25, we are looking at earnings growth, in the range of around 15%. FY26 would be slightly slower, but yeah, I mean, FY25, we are still expecting reasonably strong 15% earnings growth. So, even, if we build in a small derating of the markets, the on an overall basis, the index should return close to say 12-13% or so.
Mahesh, the other thing I wanted to understand is, there is of course a big event, right? You'll have the elections as well pretty soon. Could that be a market moving event, or do you think the market pretty much has priced it all in post the state election verdict?
I think most of the investors, I would say domestic investors and many of the international investors who track India closely, I would say have factored the possible outcome already. But as I mentioned earlier, I still have that sense that a lot of large global mandates are still sitting on the sidelines, and I think post elections, assuming that there's a continuity and stability, on the political side, we will probably see more foreign flows.
That brings me to, what PSUs have done. The untouchables of the past decade, or, many more as well, have really been the shining stars all through 2023, right? But again, the rhetoric on whether or not there is continuity of the government and the policies, etc., a lot would depend on the continuity of the PSU rally that one is currently seeing. And I'm talking ex-banks right now.
Yeah, true. So many of the state-owned companies appear reasonably attractive on valuations despite the recent rally that we have seen, especially on the mining side, the power utility side, and there are a few other subsegments which look reasonably interesting. One could argue that possibly some of the other PSU names on the defense side and some of the other segments are not that cheap anymore. But yes, one segment of the state-owned companies still appears quite reasonably attractively priced at this point in time.
Mahesh, what to your mind is going to be the way forward for global denominated sectors? Because that's a tricky one to call. China will decide metals, US will decide IT.
That's right. So my sense is that we are still looking at an environment where global growth and the US GDP growth is going to be slowing down in CY24 as compared to CY23. And there could be some revival beyond that in CY25. But at least the next 12 months, appear to be a weaker growth, year. So that's the reason why we continue to stay underweight on IT services. And maybe once we begin to get towards the tail end of the next calendar year, and maybe the market would have factored in, by that time, the demand weakness, etc., it would be a good time to start considering at that point in time. But for now, we are underweight on IT.
Mahesh, hi, morning. Just going by the report, given that the outlook is that the consumption trends have been broadly resilient, what exactly does this spell out for the sector going ahead, noting that the inflationary concerns do continue to remain an underlying concern for the space?
I think consumption can be broadly categorized into three parts. I would say the top end, the middle end, and the bottom end. I think the top end of the consumption is doing extremely well. The middle end, we have seen some selective, sectors, subsectors, where we have seen slowdown, which is like consumer durables have seen slowdown, like the air conditioning, the refrigerators, and even some of the kitchen appliances, etc., have seen slowdown. But still, looking okay. But it's really the bottom of the pyramid, which still continues to struggle, in my view. And it has taken surprisingly long for that segment of the consumption basket to recover. My sense is that, say over the next 1 to 2 quarters, things should begin to improve, but that still continues to be, a drag. But having said that, I would still say that many of the consumer stocks are still trading at expensive multiples. So I would say that I'm, much more favorable for capex-oriented sectors, be it like banks, industrials, real estate, power, telecom, etc. So we would be overweight on those sectors, and we would still be underweighting consumption sectors, barring autos.
Mahesh, so which end of the market to your mind right now is mispricing growth on the upper side and on the lower side, where there could be derating because assumptions are very high and we could be in for a disappointment? And where do you think assumptions are low and we could be in for a surprise?
I think, in terms of the earnings growth at a very broader level, the market expectation, as I mentioned, about 15% earnings growth seems to be realistic to me. But yes, there could be, some like disappointments here and there. I mean, like for example, I do expect that in the upcoming, budget, given the fiscal consolidation targets that we are looking at, there will probably be some slowdown in the government capex growth that we will probably see in for FY25 and for FY26, and that could create some near-term pullbacks. But I don't think the possible slowdown in the government capital expenditure growth, will be a negative for capex cycle from the long run perspective, because the housing cycle and the corporate capex cycle is trending up very nicely. So there could be some of those, near-term, pullbacks that might, get created. But I think those pullbacks will get bought into, according to me.
When you say that you expect that post the election mandate, more flows will come, don't you think there is too much of reliance on flows? I mean, from last 3 months, we've been using the phrase that FIs will come back. The Hindi colloquial would be, यहाँ नहीं अब नहीं तो कब कहाँ जाएंगे FIs. There's just too much of attention centered around the fact that flows will come back, and they are the ones, and FIs will come back and they will drive the markets higher.
No, I think that's still a reasonable expectation, because as I mentioned, our analysis shows that the emerging market funds have a very small overweight on India at this point in time, and many of the large global mandates are not really present. And now, given the size and the scale of the economy and of the markets, I can definitely see from my personal interactions as well that Indian markets is definitely showing up on the radar screens of a lot of large, global funds who haven't yet participated in the, in the markets as such. And also, many of these funds that have been historically invested in, China for a long period of time. And we know the geopolitical changes that have been happening. So all those are the factors that are supporting this expectation about the foreign inflows improving going into CY24.
And do you expect the domestic flows to continue? Because to be very frank, Mahesh, I mean, we've discussed last 5 minutes on global flows, but the importance of domestic flows cannot be ruled out. We're looking at a number of about 1,30,000 to 1,40,000 crore only coming via the SIP route.
Absolutely, absolutely. No, I think domestic flows has been a very, very strong backbone for the Indian markets over the last, 5 years or so, or maybe even longer, actually. And actually, this is a trend that we've seen in many of the regional markets. We've seen the other markets like Australia, Korea, Taiwan, etc. over the last 25 years or so have switched completely away from foreign-dominated markets to local or the domestic-dominated markets. And I think India is making a move. The Indian markets are making a move in the same direction that Korea and Taiwan and Australia have seen, over the last, couple of decades. So it's not something that, that hasn't happened elsewhere in the world. I think India is kind of following, the suit. And I still believe that there is, ample opportunity for the domestic flows to, kind of continue, because the Indian households at a gross level save about $750 to $800 billion annually, and the kind of numbers that you have talked about is still less than 5% of the annual savings of the households. So I don't think that there is any structural issue with the with the domestic flows, or the flows have gone to a level from where they have to come down. I don't really think so.
Give us a sense as to what the outlook is as well when it comes to the liquidity situation in light of the big event as well that is lined up. The fact that we have seen quite a comeback from the FIIs, what do you believe that the next year will hold in store?
So as I mentioned, I'm expecting 12 to 15% return from the broader indices, and there will obviously be some sectors that will do much better. And I think the sectors that will be doing much better are the investment-oriented sectors. So as I mentioned, I still like the industrial segment, the capital goods, the real estate, power, banks, of course, because many of the large banks have been laggards in the last 12 months. and that's the only sector which is actually looking quite attractive on the valuation front. So those as well, and of course, as we discussed, many of the state-owned companies in the power, utilities, mining space also appear to be quite attractive. Whereas I believe that some of the sectors that will probably underperform are the consumer staples, consumer discretionary outside of the autos, the energy sector, the IT services. I think those will be some of the underperformers in my view.
Government theme according to you, railways, defense, power, a lot of attention has been centered around railways, defense and power.
Yeah, I think power is looking like a very, very strong story to me. I think, if you look at the capacity utilization of the thermal power sector in India, we will be crossing 80% utilization level next year. Now, that kind of utilization level is something that we have never ever seen in the last 25 years. And my sense is that given the strong demand environment that we're getting into, given the fact that we believe that the next leg of the GDP growth is going to be investments driven, which will be more power hungry. So this 80% plus utilization levels can sustain for the next years. So from that perspective, it looks like a very strong theme to be following, even from the next 3 to 5 year perspective. As I mentioned, a couple of other themes, railways and defense will just need to kind of, weigh in terms of the valuation versus the near-term outlook. Because as I mentioned, the fiscal pressures will probably mean that the government will need to tone down the capex growth going into FY25. So we'll need to see, how those subsectors get impacted. But by and large, broadly speaking, there are several state-owned companies that are looking very attractive at this point in time.
It's interesting that you say power because it's almost been a frenzied sector, right? If you especially look at the financiers. I mean, the recent listing of IREDA, what PFCREC have done in the past year gone by. Mahesh, you think it's time to not take concentrated bets now on power and look at the infrastructure per se, stocks that haven't moved, the ancillaries that will come to the fore perhaps in the year to come?
No, I would basically say that the overall, chain, I mean, starting with financiers and the power generators and the transmission companies and the ancillaries, that you mentioned, the whole chain stands to benefit. And while, as you rightly mentioned, the stocks have gone up quite a lot, several of the stocks gone up quite a lot. But if you ignore the stock price movement over the last 6 months or the last 1 year, which actually looks quite astronomical, but rather, if you just focus on the absolute valuations, whether you look at the comparison for the financiers between the return on equity versus the price to book, it doesn't look, that stretched. So yeah, there can be some pullbacks, but even if you take a 1 year, 2 year, 3 year view, several of these names will actually give much higher than the market returns.
Okay. Mahesh, what is the what-if risk for 2024? Is it Fed? Is it election? Is it China?
I think the risks, according to me, are twofold. One is obviously the unforeseen global risk, and that is something that we need to keep in mind. In fact, one of the things that I would highlight, and we have been highlighting this from the global standpoint as well, that the private equity space globally can see some pressures because that's been one segment where there has been leverage investments, and if something were to kind of go on the unexpected lines, then that can actually create some kind of a risk of in the equity markets. And of course, I mean, there could be some other unforeseen global events which we always know kind of keep on happening once every few years. And the fact that the global markets have done very well, generally speaking, over the last say in the post-COVID world, so over the last 3.5, 4 years, so one cannot rule out the possibility of some global event. But I would say that's really the key risk to kind of keep in mind, but something that we cannot really track or cannot really keep our hands on at this point in time. And secondly, as I said, given where the Indian valuations are, there is a very, very strong expectations of corporate performance and earnings growth. And if there were to be some disappointment, I think that would be the other sort of factor to keep in mind, the burden of expectations, given where the valuations are.
And curious to get your take, Mahesh, as to what's been happening within the primary markets. It has been a very hectic year when it comes to a lot of listings as well that we've seen. Is there any opinion or views on the kind of valuations that they've commanded, how the businesses have shaped up?
So I'm actually quite optimistic about a lot of these new listings and the new IPOs, because what is really happening in the Indian markets is that after a long period of time, we are seeing newer stocks, newer sectors are entering the stock markets, and it actually is a broader reflection of what's happening in the economy. There is clearly incremental risk appetite in the broader economy. I'm not talking about the markets here. I'm talking about there is a improvement in the risk appetite in the broader economy. So the more new businesses and more new sectors are emerging, and what we are seeing in the stock market is just a reflection of what's happening in the real economy. So over the last 10 years, the mantra was that just stick to the quality, just avoid making mistakes, and your investment portfolio will do well. But that has changed in the last 1 or 2 years, and I think that change is a very positive one. And I think the investors do need to adapt to the new reality that that we are in an investment upcycle and broad basing of the market. In fact, Nikunj mentioned that the fact about the market breadth. I think the market breadth will continue to be the big factor over the next several years. And, from that perspective, a lot of these new listings and the emergence of new sectors bodes well for that.
Okay, Mahesh, great to have you on the show, and we'll see you now in 2024. Wishing you a healthy and prosperous year ahead.
Thank you very much, and wish you and your viewers the same.
Thank you so much. Okay, that's the view coming in from the house of CLS. Let's just take stock of where the market is now settled in at. We're holding on to the gains. About a 130-point move is what you're seeing on the Nifty futures alone. And by the way, the Nifty futures are now at 21,650 levels. The Nifty spot as well, holding up well above the 21,550 mark. And once again, so much traction and liveliness within the broader markets. Look at Sun TV, look at LTTS, look at a Deepak Nitrite, and then Voltas, which is holding high by about 5% as we speak. We'll take a very quick break on that note. Come right back. Lots more lined up on the other side. Back with First Trades right here in ET now. Let me welcome on board Manish Tandon, as the MD and CEO at Zensar Technologies. Manish, hi, good morning. Good to have you on ET now. Your stock price, Manish, has tripled this year, especially since you took over in the month of January. Having said that, your growth rate has been sub 0.5% sequentially. When do you see growth coming back? And, just wanted to scratch that point further because stock markets are at a record high. Fed turned, but clients are still not really spending much. What's the initial sense on how 2024 is going to pan out for you?
Well, I think it depends on which growth metric you're looking at. I think somehow people just look at revenue growth, while if you look at the valuation models, it is about the earnings per share growth or the cash flow growth. And by that metric, we have done phenomenally well as a company, 60% or so growth. And given the environment that we are, I think 60% growth in earnings per share is a commendable performance, is all I can say. But again, I'm thankful to the investors that they have recognized this, and that has reflected well on the overall stock price. As far as revenue growth is concerned, we have seen revenue growth sequentially. Since I took over, every quarter we have grown 2% or so, but sequentially. But let's see what happens this quarter, because anyway, the market remains pretty tough, as and although you won't believe it if you saw the stock prices. Today, S&P 500 was just 30 points of its of its high. Sorry. So I would say, given the circumstances, Zensar continues to do well for the investors, and revenue growth will also come as the industry turns around.
Right. I mean, I couldn't have not mentioned what the stocks have been doing. But, aside of that, Fed has turned, like I was asking you earlier, but clients are still not spending. What's the initial sense that you're getting on client spends come 2024?
Well, if I was to just look at this quarter, I can tell you that the furloughs that we are seeing in this quarter are deeper and wider than before. And if that trend continues, then we are going to be in for a tough calendar 2024. I think what you're seeing in the stock market is, as I was reading somewhere, there are these magnificent seven stocks which are up 75%, and the rest of the stocks are up barely 8% or something like that. So I think there is a two-track thing going on, and the optimism in the stock market is actually not reflecting in the optimism as far as budgets are concerned.
What about high tech? Do you see it recovering?
So high-tech vertical, see, the maximum amount of furloughs, etc., happen in the high-tech vertical, and that happens in Q3. I mean, this quarter, which is the Q3 for if your financial year is from April to March. So I would say, as I mentioned before, we are seeing deeper and wider furloughs than what I have seen in the past in the high-tech space. So I'm I'm not very optimistic about demand by picking up in this sector, at least for us. Us means our industry. I would also point out that while all of these magnificent seven are all in the tech sector, the most of them have actually cut down on the number of people that they have. If you were to compare from COVID times to today, and so while the stock prices are doing well, these companies are also trying to conserve cash and improve their profitability, and that is not reflecting in increased budgets for us.
Morning. Now, your order inflows have been strong last quarter, close to $200 million. Question is, what is the deal making been this quarter? What's the outlook ahead?
No, I think the deal making, see, typically post Thanksgiving till beginning of the year, it's a slow period for deal making because most people are wrapping up, the budgets are coming to an end, they are looking to the next year, a lot of people are on leave. So till before Thanksgiving, the deal making was normal. What was normal means it was same as Q2 or the previous quarter. And anyway, this is at this time a bit of a slowdown is there because of holidays. So and it takes time for the booked business to reflect into build business also. That one needs to remember.
Sure. But you would perhaps be best positioned to answer this. Any signs of a pickup in the US? Because in the second quarter, Europe was growing in double digits and US declined.
I personally think that till the interest rates remain high and till the quantitative tightening continues by the Fed, the budgets will remain muted. The industry will remain muted. There's a lot of euphoria around the Federal Reserve speech earlier this week or last week, and the market just went up. But if you look at it, this is not really reflecting into the brick and mortar and the real economy, and that has been the problem. In fact, if one were to draw a correlation between stock prices and quantitative easing, there will be a very strong correlation between the two.
Europe was growing in double digits and that has declined. How do you see things moving there, and how will 2004 be different from 2023? I mean, 2024 will be different from 2023.
Yeah, I would say that Gen AI is definitely, we are all very positive and bullish about what Gen AI can do for us. But again, I believe that the technology still has to go some distance before it's ready for prime time. Yes, we are quite bullish that Gen AI will be a net positive for our industry, like any other technology has been in the past.
And, can you give us a sense as to when that is going to show for you in the revenue? Because, for instance, you had Accenture saying they booked $450 million in the Gen AI project. So wanted to understand for your company as well.
So the revenue is, I mean, it's bringing in revenues. It's not that it is not bringing in revenues, but the quantum of revenues per project that you sign still remains small. It is that you can sign one project and make 15-20 million out of it. It still remains at an experimentation stage. It still remains at a stage where people are just dipping their toes in the water to sense what is going on, doing more of demos, proof of concepts, etc. And while deals are translating into revenues, the per unit value of the deal is not very high.
Okay, thank you for joining in. So yes, that's the view coming in from the management of Zensar Tech, that as of now, a little bit of caution heading into the next year. Margins will remain range bound, and yes, post-Thanksgiving, the deal-making activity as well has slowed down. That's the chart though, holding out by about 2.5% in trade today. Let's move right on then and hear it out from Saurabh Mukherjea. That's after this very quick break. Don't go anywhere.
All right, let's take a conversation forward with Saurabh Mukherjea of Massless Investment Managers. Let's understand what he makes of the current market environment and where is he laying his bets for 2024. Saurabh, I remember watching this very old cartoon long time ago on DD, which used to be called Ulta Pulta. I don't know if you remember that one, right? 2023 has been a year of Ulta Pulta, right? Power has come back, defense has gone higher, quality stocks have gone down, PSU banks have gone up, private banks have gone down. So it's been a year of Ulta Pulta, right?
And the great Jaspal Bhatti was
yes.
the creator, and still what for anybody who's interested in markets, Jaspal Bhatti's YouTube videos are still very relevant. I think it's been a year like that, especially in small caps, where I think, as you're alluding to, hundreds of small caps with no underlying fundamentals have doubled, tripled over the last couple of years. I think, as we all know, the number of demat accounts in India have tripled in the last 2.5 years. And that's the nature of markets, which is why we love working in the market. It creates these roller coaster moments. In 3 years, you create more demat accounts in one of the largest markets in the world that have been created in the preceding 30 years. And in that sort of frenzy, hundreds of small cap stocks fly up. If you ask me, the next 12 months, Nikul, the next 12 months is largely about foreign investors returning to this market and seeing what they can make of large caps. The sheer amount of money foreign investors make naturally won't go into small caps so much. It'll end up going into the largest stocks. And we're hoping that consistent compounders will continue to make money from that. We're up 26% this fiscal in CCP, where we manage roughly $1 billion for our clients. And we're hoping that as FIIs return, that 26% number will be further augmented by FII flows.
Now I'll start picking up themes looking at your portfolios across the board. So I'm picking up themes. One common theme in all your portfolio across market cap category, across classification is diagnostics. Now this is a business which has again gone through twists and turns, again ulta pulta. Post-COVID it went up. Then once COVID settled down, growth rates really matured, competition increased. Why do you like this space? Because it's a highly competitive market when it comes to the entire diagnostic space.
Yeah, so that nicely put. So I think in the last year and a half, as private equity and venture capital money has pulled back from the space, Nikunj, as PE money has pulled back, we've actually seen a reduction in funding for the smaller path labs, and as a result, the companies that we own, Dr. Lal's in Consistent Compounders and Rising Giants, and Vijaya Diagnostics and Metropolis in Little Gems, they have actually done very well over the last 1.5 years or so, because pricing power is back, competition intensity is dying, and our reading is there'll be massive consolidation in this space. It's a big industry. I would say there's something like $10 billion of revenue on the line in diagnostics. There's only 3 or 4 organized players, the ones that I named, and therefore the consolidation opportunity is huge. Just yesterday, Vijaya Diagnostics announced an acquisition of a small player in Pune. As you know, Vijaya is a South-based player. They're acquiring a Western India-based player. 2 years ago, Dr. Lal's acquired Suburban Diagnostics in Mumbai, the second largest player in Maharashtra. So as this space consolidates, we're hoping that we're backing the right horses here. And Dr. Lal's through COVID made us a lot of money. We went through a rough time in early part of 2022, doubled the investment in summer 22, and again we're looking good in Dr. Lal's. Vijaya Diagnostics over the last year has been a good investment for us. I think there's plenty of barriers to entry in this space, and competitive intensity I don't think will ramp up meaningfully further unless a lot of new money pours into diagnostics again.
Is it a coincidence that you own TCS, Titan and Trent? Is it the Tata, or this call has been taken based on the individual merit?
I think it's on individual merit. Well, there is a common theme though. There is a common theme as I think about it. I think Chandra's ascension to the chairman role at Tata has made a difference. As I travel around the country, yesterday I went to Boisar to see the market there. What Zudi was doing across the country is absolutely phenomenal, and it's very difficult to believe that these sorts of disruptive moves across the Tata Sons holdings can be happening without the balance sheet backing of TCS, 50,000 crores of cash flow pounding out there every year, and B, I think Chandra as a chairman has been a change for the better. I think the group has become aggressive, disruptive, creative, and it's just a joy to see Tanishq, Chroma, Zudio spread their wings across India.
Just want to take a moment, Saurabh, and mark the 2 listings on your screen. DOM, and it's been no surprise to see a pretty stellar listing, a nice 70% premium. Remember, the issue price was at about 790 rupees, given that there had been very strong response as well to the IPO in terms of the subscription numbers, the fact that of the last 3 years as well, when it came to revenue and profitability, there had been a substantial turnaround in terms of their losses to profits, all of that boding well, and which is why you're seeing close to 1386, a 70% plus premium. And not too bad as well for India Shelter, which also listed today. You have a pretty 20% plus premium on that as well. So 2 healthy listings panning out for the day. It's in the affordable housing segment, and you did have pretty strong fundamentals as well and strong participation. So Saurabh, why don't I ask you about all of the action that we've seen within the primary markets, the slew of listings as well. It's been a plethora of them in this year alone. What have you made of the kind of businesses that we've seen, and just the fact that there has been so much participation?
Yeah, I think it's linked, right? The fact that you're getting these tripling of demat accounts has obviously played a role in rapid inflow of retail investors into IPOs. In parallel, the mutual fund industry has seen strong inflows that's allowed them to put a lot of money into IPOs. And I don't see this abating. I think financialization of savings in India is continuing. My estimate is something like $170 billion every year is now shifting from Indian families' balance sheets into the financial system, and that's powering the primary market. Every week you're getting 3-4 IPOs, and I think that 2024 will be more of the same. As you'd expect, out of every 100 IPOs, 4 or 5 will go on to become great companies. Our job is to see if we can make a decent fist of choosing those 4 or 5 and leaving the other 95 IPOs to do their own thing.
Saurabh, hi, morning. I'm curious to know about the addition that you've made in the Little Champs portfolio, Tega Industries. Tell us all about it.
Right. So look, I mean, we consistently look for companies who, in commoditized industries, occupy a niche where technology, process, trust becomes a barrier to entry. So in the steel industry, Tega occupies such a space. Just to sort of simplify it, when iron ore is mined, these are huge sort of chunks of stone, as big as this room. To actually process that iron ore and turn it into steel, you need to crush the stone into smaller pellets. For that, you need highly specialized machines. Only 4 companies in the world make these machines at scale. Tega is the 4th largest of them, the only player in Asia who makes this machine. And as the metals industry, steel industry booms in India, in the recent GDP announcement, you saw steel volumes are growing 19%. As the steel industry booms in India, we reckon Tega's products will be more used in India. More generally across the world, as the gold industry booms, Tega's products are specifically very useful for the gold mining industry. They have a specific IP around it that's proprietary to them, and it's a very similar sort of GMM formula in that regard. Commoditized industry, gold or steel, but at the entry point of that industry stands a specialized player with proprietary technology. And we think the promoters over the last 40 years have built a very interesting company that we got into 2 months ago after doing around 6 months of research on Tega.
So is this one of those classic compounders, like just 2, 3, 5 year you have a view in terms of earning visibility? What happens to the stock is a function of market and technicals, but in terms of the earnings visibility, do you see this kind of visibility in Tega?
So it's a good point. So we looked at the industry structure of Nikunj in this industry, right? The industry of Tega belongs to. There's been no new entry in this space for the last 20 years. So I went back as far as I could with my colleagues. We couldn't see any new entrant. And as you'd expect, whether it's the gold cycle or the steel cycle, that goes up and down. But the pricing of the products that Tega makes remain reasonably stable. The demand fluctuates though. So what you get is downside protection when, say, the gold cycle or the steel cycle comes up. You get downside protection, and you get upside participation when the cycle booms as it is now. So there is no, in the case of industries like this, you can't sort of get the consistent compounding that you get, say, with an Asian Paints, where profitability grows at 20-25% reasonably steadily. But in a case of Tega, or say, I'll give you another example, Grindwell Norton in our Rising Giants portfolio, these sorts of companies, you get the upside when the capex cycle is switched on, but you don't get hammered on the downside when the global economy softens up. So Grindwell Norton and Rising Giants, Tega, RHI Magnesita in Little Champs is also a very similar stock. RHI Magnesita makes the refractory tiles for steel plants. You get upside participation in steel demand booms, but because it's very difficult to enter RHI Magnesita space, the refractory space, you don't get hammered when the cycle turns down.
Saurabh, I was just having a very interesting conversation with a banker yesterday, and his view was that, look, there was a time when HDFC Bank and Kotak were getting a premium. Why? Because they were the good boys in a bad world of banking where everything, in a sense, was going through a mess. But now NPA is not a problem. Every bank has a clear line of sight for growth and low NPAs for next 2 or 3 years, which means the premium which was commanded by Kotak and HDFC Bank, that automatically gets diluted. Now they are part of the gang, so to speak. Earlier they were the good boys in a very opaque kind of a sector. If that is the positioning of the market and that is the market view, do you think the premium for HDFC Bank and Kotak Mahindra Bank ain't going to come back soon?
So I think premium is clearly down. I mean, I agree with your banker friend. Over the last couple of years, the gap in price to book or price to earning ratings, that the premium that HDFC and Kotak enjoyed is gone. But will it come back? I guarantee you it will come back. Why will it come back? Just take the whole last 3-4 months of controversy in India about unsecured lending, and certain lenders were ramped up their unsecured lending books without due consideration for asset quality. Some of them have pulled back quite abruptly. Look at SEBI's announcement yesterday evening about certain AIFs being used to evergreen tens of thousands of crores of loans. I'm just quoting SEBI's words: tens of thousands of crores of loans is the headline in a newspaper today. So whether it is naughty lenders using AIFs to do naughty things, or whether it is irresponsible lenders giving 10,000, 20,000 rupees loans, unsecured loans to low-income people without underwriting quality. The nature of finance is that when people get excited, when lenders get excited, they overextend themselves, they do funny things with their balance sheet, and therefore they blow up. And if you take a 10, 20-year view, as we try to do in our consistent compounders portfolio, if you take the long-term view, you stay with high-quality, cautious, prudent lenders who still generate earnings growth of 20, 21% pretty consistently. So it's not as if HDFC Bank's Kotak's caution is resulting in muted earnings compounding. Earnings compounding is tremendous, and we've seen this over 20 years. Other lenders wax and wane. A handful of high-quality lenders in India stay the course through the cycle.
What gives you conviction about, the chemical space? And I'm taking a leaf from the addition that you've made in your Giants portfolio, that's Clean Science.
So before I get into the chemical space, one disclaimer, folks: all of these stocks are in our PMS portfolios where I'm a client, my parents are clients, 9,000 Indian families and a growing list of foreign investors are clients. So onto the chemical space. Clearly, China has been dumping aggressively. May through to October, China cut prices. Chinese producers cut prices of specialty chemicals by roughly 25%, in some cases 80%, some cases 20%, but the average was 25%. Last couple of months, they seem to have stopped. I don't know why the Chinese have stopped dumping in the last couple of months, why there's been an abatement in price cutting, but it has taken place. And what we are doing is using advantage of the pullback in these prices to build positions in, again, niche leaders in the specialty chemical space. Now, Clean Science is a world leader in MEHQ. What is MEHQ? When plastic is made, basically monomers are enough to create plastic, but sometimes the plastic producer does not want the monomer to join up. So you need something called an inhibitor, which prevents the plastic from getting created. MEHQ is one of the leading inhibitors in the world, and Clean Science is the world leader in producing this. Innovative firm based out of Pune. It's not just MEHQ. We've seen them do a raft of other very innovative things in specialty chemicals. For example, something called HALS. This is very high-end chemicals. It has never ever been before made in India on a commercial scale. Clean Science has pioneered the production of HALS in India. And we like their science prowess. We've spoken to their clients. The clients rave about them. And hence we took advantage of the spec chem downturn to load up on Clean Science.
Okay. So, Saurabh, just one last point on this FI comeback, and that seems to be a common theme, that 2024, there is going to be a flood of flows which will come back, and the bid by foreign flows will take markets higher. My only reservation with that view is that is becoming like a consensus view, that our best friends who've deserted us for last 2 years, they will come back and they will take markets higher. Don't you think markets will start pricing this consensus FI comeback view, or the effect of that?
So you're right, Nikunj, it will. It's just that the power of domestic inflows into small caps, the power of retail inflows into small caps have been so powerful, so what should I say, so overwhelming over the last couple of years. The small cap inflows have been so overwhelming that the overvaluation of small caps relative to large caps is at, I think, is an all-time high. So we were looking at charts yesterday, the Nifty 50 versus the bottom 200 stocks in the BSE 500. There is no precedent in Indian history for what we've seen in the last couple of years. Given that anomaly, the discounting has a long way to go, i.e. the repricing of large caps is a long way to go. I agree with you, some of it's happened over the last couple of weeks, but I think this is just the beginning. I think the repricing of large caps and sanity returning to the market, where risk and reward are priced sensibly across the market cap spectrum, I think has a long way to go in 2024.
All right, good to have you on board, Saurabh. Thanks very much for taking us through some of the recent additions in the portfolio as well as the overall market and sector outlook. Good to have you on board. 21,541 mid and small caps as well, contributing on the upside. We'll take a very short break and be right back.